Happy Tuesday. I'm Turtle Capital. Today is September 5th, 2023. With me is Joe Catanzaro, our chief propeller head here at Swami Research. And we're going to walk through some slides, some recent signals that Joe is watching close. We're also going to do a little look back, kind of like Monday morning quarterbacking on some recent signals that we've given you here at Swami Research. And we're going to walk through some things we got right, some things we got wrong. And I think this will be useful opportunity to share some like tips and tricks for using the Swami score to manage your investment portfolios. So with that, Joe, how are you? Thanks for coming on.
I'm good. I'm good. I really like propeller head. I'm going to get that on a business card, I think.
Let's go. All right. So with that, we're going to walk you through some slides here, and yeah, looking forward to it.
All right. So hopefully you can see that as I'm
Yeah,
sharing
looking
it.
good, Joe.
Great. And this is going to be a little bit of a sneak peek at what some of what we show in the slides that we prepare every week. The first few that you're going to see are part and parcel of a lot of what we show repetitively throughout the week. We have daily updates where we show that signal re-ranking and how things are looking day to day. But then we like to do a weekly wrap at the end where, Sunday night into Monday to prepare you for the week, we go into a little bit more of a deep dive. So here's an example of kind of how we show our data, and I'll walk you through not just what you're looking at, but how to read it. So this is what we call, a market dashboard, and the numbers that you're seeing there are the Swami scores. And just as a refresher, the Swami score is a kind of a one-stop shop number that ranges from negative 100, which would be really, really bearish or really bad, all the way to positive 100. So a rough rule of thumb would be a negative score is bad and would roughly correlate with something that's in a bearish downtrend. And then a positive score, anything above zero, would be something that's positive and in a bullish uptrend. And that's not a hard line in the sand where you definitely want to sell anything that goes below zero, and you definitely want to hold something that's staying above zero or buy it with both fists. But that's kind of a rough approximation of how we can quantify what we're looking at. And the two ways that score certainly helps us and hopefully helps anyone that is looking at our stuff. Number one is what we're not trying to do is predict what will be. I mean, that kind of happens as a consequence, which is great. That's what everyone wants to do in markets, is to see what's coming and be able to be in the right assets. But what we're really trying to do with that score is remove the bias to help you see what is, right? So if you have a bearish view on the stock market because of one narrative or another, and maybe it's not just a narrative, it's something more concrete, like monetary policy, the Fed tightening, et cetera. It's okay to have that view, but the score is going to gut check you on that and say, well, yeah, maybe there's a lot of bearishness out there, or there's a reason to believe that the market's going to go down over the next 3 to 6 months. But the here and now, and this is again looking back, not just currently, but also over the last 6 months, where we really saw that Swami score change. Equities are a place to be, or at least they have been, and they still are currently, and they have been for the last 6 months. And our score was kind of picking that up. So it was bearish for a good chunk of last year, and we saw that kind of change pretty considerably, not just in like the SPY, but in a lot of assets, all the way back in March. And if you've been following the weekly wraps and the writing that we've been putting out there, you'll see that our tune kind of changed considerably around March and has been, more a buy the dip mentality over the last 6 months. And sure, that could change. That could change at the close today. It's going to depend on on where that score goes. But that's the first of two things that we're definitely trying to do for ourselves and our trading and our PAs, but also for you. The second thing, and this is I think game changing for me and is for a lot of people, the feedback that I get, is the rank ordering. So what you're seeing here over on the left, where you see the 5 big asset classes, we use the 4 big ones in crypto, which has kind of become its own thing. So commodities, currencies, bonds, aka fixed income, equities, and crypto, and rank ordering them. So you're not just seeing 5 in the same order or alphabetical order over on the left. That order is going to change. So commodities right now are, their strength is 18, and that's just an amalgamation. That's every commodity in our little universe that we track. If you average them together, which of course is not telling you a whole heck of a lot, is averaging 18. Then if you look under the hood at the components of that, well, what's really driving that positive score right now? Energy, for sure. And we're going to get into that. Then you've got currencies, which is of course being driven by the dollar. Bonds actually, they've been trashed for a while, and we've been ragging on them quite a bit. You're actually seeing an uptick in that score, largely being driven by the riskier side of that curve: drunk bonds, high yield, et cetera. Then you've got equities, and then at the bottom you've got crypto, and I'll get into that too. That's kind of been a head fake for us. But that, just to look at this dashboard once a week, Sunday night, and see something like this is really illuminating for us. And then what you see in that middle column and the rightmost column, where you see U.S. sectors here and then factor exposures, is that's really taking what you're seeing in this, under the hood within this equity component, and blowing it out and saying, like, okay, well, of U.S. equities, where is that strength? That strength is in energy. And this feels like, if you look at prices today, literally today, it feels like an obvious thing. Oh yeah, of course, XLE and XOP are breaking out to new recent highs. But if you've been following us for a while, you know that energy and housing have been at the top of the list for quite a long time. But by quite a long time, I mean, Turtle, you checking on it. At least 2 months, you've seen those two at or near the top of this list.
That's right.
And utilities is another one where you would think theoretically utilities would do well in sort of this constrained growth or inflationary environment that we've seen, and they were doing well for a while. Then the score dropped off a cliff, and now utilities have been, for almost that same amount of time, at the bottom of the list. So I may have a bias. I love utilities personally. Right. I've been long them quite a bit. I have a bias where it feels like this is a time where I should be long utilities, but I look at the score and I say, absolutely not. I'm not even going to entertain getting long XLU. I'm going to look at XL, even though that feels, I hate being long energy just because I can't trade it as well as I can utilities. But this is gut checking me against my own biases. So that's why we find, this setup really useful for us, personally, and hopefully for our subscribers as well. And then we do the same thing with factor exposures, where we look at high and low beta. We look at cap weighting, mid cap, large cap, small cap, growth versus value, and then low short interest versus high short interest, to sort of see, and there are times where you'll see, wide disparities between these, like even low and high short interest here. That is a pretty significant difference, that you're seeing a -2 versus a -14 score, which is telling you, like, this is a little bit more of a defensive setup, even though you're seeing, bullishness kind of broadly. We are coming off of, there was a little multi-week decline a week or two ago that began, a month or two ago, where SPY went down, a lot of composite stocks and securities, bad earnings, whatever, they went down. So you do kind of see this tilt back to a defensive setup. And this is just a way to, instead of just looking at charts all day, you can kind of take everything that's out there in the universe and distill it into something that ranks it. Where this really comes in useful is sort of that second thing I was mentioning, the rank ordering, is when you start to look under the hood here. So this is another example of, these slides we put out every week. So these are, I'll just jump back and forth between these two slides. So this is commodities, crypto, and currencies, which are all, you kind of think of them all kind of related. They're all on this slide. And then on the next slide is equity sectors and factors. So it's a little bit busier of a slide, but it's everything that would be either a sector ETF or a specific factor exposure ETF, like momentum, NTUM, or you can get very specific here, mega cap growth, MGK. I believe we're up to, check me on how many we have in our universe. I think it's like over 200 or 220
over
now.
250. Yeah.
250. So we grow it. When we find ETFs that make sense to add, we want to add ones that have somewhat decent trading volume. We don't want to be in these sketchy things that are trading like 10,000 shares a day. We want something that has a little bit of liquidity to it, but also that cover the breadth of all asset classes and composite markets within, that we can get that are tradable. And this list changes constantly. There was a recent couple months ago where a bunch of commodity ETFs just went away. They were just not making money, and I forget which, whether it was iPath or which big company owned those ETFs, and they ended up going away, and we lost the ability to trade some of those commodities. But we're always looking and find, like, okay, we lost maybe the copper ETF, but we've got CPER now in there. So there's ways to kind of get exposure to everything that you're seeing on on this first slide, just based on what's ranked. So real quick, I'll go through just what we're seeing this week, and then we can kind of, after we're done here, we'll take you through kind of special edition slides that we've got for today. We're looking at things on a little bit longer time horizon. So the big thing to us, the big change that's happened over the last couple of weeks, has been the dollar. And that's generally going to be the case, that if the dollar is doing one thing or the other, you're going to be able to make a determination about what a lot of different assets are doing. That's not always the case, but it definitely has been a big change going all the way back to, and actually I'll jump ahead. I know I'm like jumping around here, and I'm going to go through this slide in more detail. But this reversal that we call, this was sometime in the middle of July, actually proved to be more of a Prussian call than even we anticipated. So this was in the midst of a bearish downtrend for the dollar. We got, and I'm gonna again walk you through in a second how to read a slide like this, which is just how we utilize the data in our process. But that fractal reversal there was dead on, and it didn't just anticipate, you know, a short-term pause in the decline for the dollar. Actually, was at least for the foreseeable future, it was the bottom in the DXY. And since that bottom has formed in the DXY, you've seen a lot of things that were working stop working, or the other way around. So, you know, it's not always the case that equities or commodities are going to trade inversely to the dollar, but at least since that pivot point in mid-July, you have seen that in some, but not all assets. So that being the big change that we've seen. Related to that, but maybe not being driven by that, you know, there are definitely points where you'll see oil and energy do very poorly if the dollar is strong or doing well. That has absolutely not been the case. You've seen a strong resurgence in oil and energy, just in terms of signal strength over the last few weeks. And you've actually seen, you know, there was a time or two where if you were really quick and following, you know, what we call the Swami ad level and Swami trim level, there was a spot to at least open a starter position in some of these things. And you've done really well. If you were quick, I wasn't quick enough to get it the day that it was like blink and you miss it kind of thing a week or two ago, across the board in oil and energy. You saw XLE, XOP, USO, BNO, like it was throw a dart. It was the same chart. So, you know, those were the two big takeaways for us a week ago. And this, again, some weeks we have big calls and we see big changes and we're like, you know, this is a spot to act. And then there's other weeks where we're just like, this is kind of a continuation of what we've been calling for the last few weeks. That's kind of what we're seeing to start this week is the movement here is a continuation of what we've called over the last couple of weeks. And then I'll just touch briefly on crypto. You know, it's still an avoid. We've been calling that, you know, an avoid for a while. I think, you know, when I touch on crypto specifically, yeah, there was if you got it bottom to top, you could have got 100% from the bottom of Bitcoin, you know, whatever that was a few months ago. I mean, we're not in the business of being able to bottom pick that particular point, because you can't do that with any consistency without getting something like that wrong. So, you know, we've avoided crypto, we've avoided bonds, we've avoided just assets that have just not shown us anywhere near the relative strength that we're seeing from a Swami signal score perspective in things like oil and energy, and more recently the dollar. And then just quickly on equity sectors and factors, you know, this is data as of the close on Friday, Friday. It was a profit-taking week. You know, even the trash rose to the top, and that's good and bad, because if you're out of position and you maybe got overzealous in some things and their scores weakened significantly, but you still have those longs on the book, the movement last week was great to be able to take some of those profits. But if you're looking to hammer new longs or open new positions, you know, we can talk about how the market's acting today, Tuesday, September 5th, but as of the close Friday, there hasn't really been a ton to do from a long entry perspective, which is okay. I mean, you're going to get those moments are few and far between. And, you know, we had a couple weeks ago, we started rank ordering some of the sector and factor ETFs that we were seeing that were particularly strong. Some of those have panned out, like I keep mentioning. The energy ETFs, XLE, XOP, have really panned out, as well as the housing ETFs, ITB and XHB, have panned out. But the others were starting to weaken. So those are listed here on the right: RSP, IWD, VTB, Qual. They were strong, but we saw not just price declines, but volatility breakouts, which is often like a forward-looking. If you're seeing a volatility breakout, you know, sometimes you'll see like a big upswing back up in price, which I think is what last week was, and that's just an opportunity to sell. That's what we would do. That's what we see the big boys doing. So that's kind of where we say, all right, the volatility characteristics have changed in some of these assets, and it's time to reconsider if this is where we want to deploy capital over something that feels like a fat pitch, like energy and housing do right now. So that everything I just talked about is what we offer every week, and even more granular than that, the signal rankings themselves we send that out every night. It's more the analysis of it we'll do weekly. But now what I'd like to do is walk through, not just some charts of where we've been and calls that we've made, but also helping people learn how to read what we're showing. So, again, I can zoom in here. I know this is pretty small. So just going from, we'll call it left to right or bottom to top, right? So on the bottom here, this big window is price. This should be pretty obvious to everyone, using candlesticks to show when price is going up, price is going down. I think just about everybody's going to be watching this is already familiar with that. What you're not familiar with is more, our proprietary process and model and how we use it is this blue line here is what we call a trend line. And that's different from the way that people typically think of trend lines, which is like you draw a physical line, like with a crayon, bottom to top. And that's kind of like your, which is not a wildly, inappropriate way to do it, because that's at least going to give you a broad idea of when something's in an uptrend, and then more importantly, when that trend starts to break. But this trend line that we're referring to is more quantitatively driven, and it's intricately related to the signaling process, to to how we're taking in all of that price and volatility and volume data and incorporating it into an actionable signal for you. You'll see that generally, although not always, if price is above that trend line, that's bullish. If it's below that trend line, that's bearish. But the way in which we actually derive what we're calling trend from the data is it's not always a one-to-one, that you're always going to get a bearish downtrend signal if it's below trend or vice versa. But that's generally kind of like our line in the sand, where if we're long something, this being the dollar, we were calling for dollar up and long dollars for majority of last year, 2022, and you saw a big change in the signal. I think it was end of October, beginning of November of last year, right here, and that was like our out. My personal account was long dollars for a while up until then. I had the way it's generally going to go is entry points that you have right when that signal is breaking, you're going to end up being wrong. But the hope is if you've been riding that trend long enough, there are still profits to be taken as long as you didn't get too over your skis at the end of that trend. I think the saying goes, the trend is your friend except at both ends, and that's kind of where we are here, or were. And now you're seeing a change in that almost the other way for the dollar, where you've had kind of a prolonged downtrend for the better part of a year, and now we may be seeing something change. So that was a lot in there. What I'll also add is this sort of cloud or band that we have around it that you see colored green here and red here. Hopefully that's intuitive. That's not only the color of it is not only telling you whether something's in an uptrend or downtrend, obviously green being an uptrend, red being a downtrend, but more importantly, that border is a dynamic and constantly shifting spot to make a good decision, whether that's buying or selling. So we call it the top of this band the Swami trim level, and we call the bottom of the band the Swami add level. And that's done intentionally. We're not saying buy and sell, we're saying add and trim, because really this is where you start to make the process your own. If your style of trading is to go all in when you see an asset shift, and your account is small enough, that may be something that you do. If you're managing a much larger book, and that's not something that you're able to do, or you're able to just buy it all at once, this is hopefully going to give you a spot to, okay, today is a spot to maybe take this position up a little bit to a little bit higher percentage, and then vice versa for when you're looking to take profits. Like it's great to get into something when it's working, but when do you get out? And it hurts just as much to take profits too early than to as it does to get in the wrong thing and have to take a loss. So that's what we're trying to do with this band here. I covered the color, obviously green being bullish, red being bearish. There's also gray, which you'll see that's sort of neutral. It's sort of, we don't really have a call on whether there's something going, and gray usually doesn't last that long. It's more just we're waiting to see the signal pan out one way or the other. Moving up to the top here, this magenta line, again, this is just like under the hood stuff, real like, nerdy stuff to kind of just show you what's driving the signal, but it's not, the meat of what we're trying to show here is captured by the bands themselves. But the magenta line is volatility, which also has a trend line, this blue line here. So you kind of think of volatility the opposite. If volatility is below its trend line, that would be bullish, because you've got kind of a smoother ride, which is what everyone's trying to chase in markets, is low volatility. And if it's above that line, it's bearish. You're in for a rockier ride. What's not captured here on the slide, but just to real quickly touch on it, is, for the sleuths that are looking at this, these dark red boxes here and these blue boxes here, what that's connoting is in fractal speak, whether volatility is trending or mean reverting. So when you see these reds start to come in, volatility is trending, meaning the direction it's going, it's likely to continue in that direction. So volatility is increasing, it's likely to continue. That was a good thing to know for the dollar, and may have kept you out from getting too over your skis bullish here when you saw this potential bottom in late January, early February, and vice versa. When you're seeing mean reverting volatility, it's an indication that what you're seeing may not be what you're going to continue to see. Mean reverting volatility often is correlated with bullish price action, because you see that with the VIX all the time. VIX is constantly, like, if you look at a chart of the VIX, it's just up, down, up, down, up, down. That's just how it tends to go. When you see persistent volatility, that's definitely at least a warning sign. And then the hardest thing to really dive into what we're showing here, and again, this is just for the curious. The easy part with this top line here, the black line is a Swami score. That's easy. So you'll see it's hard to see because it's cut off, but negative 100 to positive 100. You see the DXY, about 55 here is the score as of Friday. That's about where it is. It's about halfway between 0 and positive 100. That's very strong. Anything 50 or above is quite strong. Anything negative 50 or below is quite weak. And you'll see generally the Swami score is going to oscillate between those levels, occasionally, going higher or lower. But I do want to call your attention to are these, and hopefully you're seeing the zoom in here. These circles, green or red, are our trending entries. So within the system that we built, what you'll see is if all systems are go, meaning there is it's a bullish uptrend for an asset and price is at its Swami ad level, that's going to generate a green circle there. And that's telling you, like, this is a spot to get long. So same thing for red. This would be a spot certainly to sell, or at least to short, if that's what you're into. The triangles are, we talk about this a lot in our recaps, are something called fractal reversals. So that's where you're kind of ignoring trend, and you're saying, just based on what price has done over the last, from a fractal perspective, over the last however long, it's gone too far too fast in one direction or another. And we have two levels of that. We have an intermediate signal and then a longer term signal. The intermediate signal is a smaller yellow triangle. The longer term signal is over here on the right, this bigger orange triangle. So that was this signal. We made a big call in our notes at the time that this was something you don't see any day. We haven't seen one of these signals in the dollar. We hadn't at the time in over 2 years. This is going back to, this is a 2-year chart here. So that was a big deal for us, and certainly it's proved over the last couple of weeks to be a big deal, because that's the bottom in the dollar, at least for the foreseeable future. So that was a big correct call for us. And on that point of incorrect and correct, what you will notice as you look at these triangles and these circles is whether there's a black X inside of it or a white plus sign. And that's just our way of kind of scorekeeping for ourselves. If it's a white plus sign, it was, and I'm using air quotes here, it's a correct signal. If it's a black X, it's an incorrect signal. But there's some leeway that needs to be given with that. And what I will show here is, if I jump to, this is the current chart of ITB. I think this is a good example of just our methodology for that, and why you can't just take the black signals with at face value. You got to kind of take it with a grain of salt. The way we figure out this, I'm sorry, I'm zooming in here, but whether something's correct or incorrect is given where the bands are at the time. So here's a good example, right? This is at or close to the bottom end of the range. What we're saying is, if price can close at the Swami trim level on that day, which would be 89.27, which is up here, we would call that a correct signal. Then we take that exact distance and we add it to the bottom and say that we're just calling that an incorrect signal. So if you get in, if it goes, whatever it is, 2% up, we'll call that a correct signal. 2% down, we'll call that an incorrect. However, you'll notice in ITB, there was this big drop on the 17th of August that invalidated these 3 buy signals here, that they were incorrect. But the trend is held. So that's up to you. That depends on how you want to use the process. If you've got, your stops down here, if that's how you think of it, or you think about it in terms of percent of your portfolio, this may not be, an incorrect signal or a loss to you. It's just the way that we're defining it. And you see these 2 circles here that don't have anything in them yet, because we haven't seen the resolution. So this one here, this is actually a buy signal, this big down day. The air quotes correct signal would be if it reaches 89.54 and closes there, which it hasn't yet. And an incorrect signal would be, whatever that distance is below, which would be a trend break. So this would be an incorrect signal if it were to break down. And we're seeing potentially the beginning of that, because we're seeing some volatility today as of 2:43 Eastern time in ITB. So jumping back to our slides here, again, that's just, a quick primer in what you're looking at when you look at that. Now, what I'd like to do real quick with our last remaining minutes is just go through some of the signals that we've gotten right, some of the things we have the last, going back almost a year. So here's oil, something we're calling it inflation redux. So this one, this Swami ad signal, which was, just a few weeks ago, actually, I can give you the exact date. This was again, this is USO, and this is just which has already been proven to be a correct signal. On Wednesday, 8/16 was an entry, and that was a bang on signal. There was basically no close where you were in the red if you took it long. Not only is that a correct signal, yay, good job us, but more importantly is the difference here to what has been and where we see sort of a corollary or something similar. And looking back, I saw we haven't really seen a sustained buy signal in a fresh bullish trend in oil after a prolonged downtrend since, I have the date written here as March 18th, 2021, which is this other green arrow here. And you can see what happened after that. It was off to the races. Now, we're not projecting that exact kind of, I think it was 120% rise over 15 months is what we're looking at here, but we're leaning more toward that than we are that this is a head fake and that oil is going to go back down. So that's kind of our starting point for what we're seeing forward looking, call it, over the next quarter, now till the end of the year, is a significant resumption in inflation linked assets, specifically oil. I'll go through some more charts here and then we can talk about what that may mean for the future. But another good call that we've had has been avoiding bonds. So this is kind of a wrong and a right call, because I do want to talk and be fair about the wrong call that we have with this. We were, like a lot of services, we were calling for a dovish policy tilt that would have triggered a buy-in duration in early 2022. That was just straight up wrong. And we were actually going counter to our signal in making that call. And what we've done since then is really try to react and just look at what the market is telling us rather than project or predict what may happen in terms of monetary policy. Because that's not what we're in the business of doing. We're in the business of getting things right on the chart and in the P&L, and not what Jay Powell is going to say. But since then, we've really, contra to, I think, a lot of services and people that have been calling for the turn in duration. We've called bonds, specifically TLT, a dumpster fire for, I don't know how long. It's been at least a year that we've been saying, don't look at it, don't look at it. Yeah. So if inflation returns, recent history would tell us that we'd expect this downtrend to continue. If policy is going to be constrained and they're going to continue to raise rates, the bond market has had this right for 2 years, that they have projected that inflation is not transitory, that it's going to continue, and that bonds are not a place to be. So that's been a big call for us, or rather a non-call. We've been, I'm showing crypto here too. It's crypto and bonds. We've been pounding the table and not pounding the table. We've been saying for part of at least of a year, in some cases more, we've been saying, do not get in this asset. Now, did we miss some profitable buy signals in Bitcoin? Yeah, you bet. There's a couple here that were correct. And this is a 100% move from, wherever it bottomed, 15,000 up to 30. If you're a little more high risk and you want to take some shots at something like crypto, go for it. But what we're trying to do is keep people out of these swings. I think there's going to come a day where crypto has its moment again. Bonds too. I don't think bonds are going to zero forever. U.S. Treasury bonds. Right. Our goal here at Swami is just to get you, from a broad perspective, get you in when it's safe to do so, even if that means giving up the beginning of the move. Yeah. Well said. If this is going to go to 200,000, I don't think it really matters if you get in at 15 or 30 or 45 or whenever it starts to look like the skies are clear. But if we continue to see constrained monetary policy, crypto is not a place where I think any of us want to be. Gold's where it gets tricky here. So I have a little pun here, waiting for Goldo. I'm waiting for Godot. I don't know where gold goes, and this becomes harder to predict. I think it's clear to us that gold generally will like or favor falling real interest rates. It's not clear if and when we're going to be in an environment where there are falling real interest rates, because that's a component not just of where interest rates are, but also inflation. So there's a numerator and a denominator, and it becomes less clear to try to parse out whether real yields are going to lead to a bullish rally in gold. Now, we did see it, end of last year into the beginning of 2023. We saw a really healthy, nice move in gold. You can see just based on the signals over the last couple of months that there's been some trend breaks, and then it's back, and it's a head fake, and there's a neutral trend. It's harder for us to get excited about gold when we see things that are just easier, like being long energy now. Although I want to be clear, not long energy as of today, certainly not entering a new position today,
Right.
because oil and energy are very, at least short-term overbought. So this is definitely not
a bigger
start those positions or get bigger. And then just the last thing I'll cover is just equities. I mean, like I said in the beginning, we've been bullish since 26th of March. This is from our note that was sent out on Sunday, March 26th, or it was the Monday after. Dips should be entertained as spots to get longer the market. And this comment was made specific to tech, but it applied to the indexes in general. That we just felt like it was an appropriate time. The skies had cleared a little bit. It was a very tough call to make because at the time everyone was very bearish and everyone believed that we were going to retest the lows that we saw in October. But we were just seeing this pattern of higher highs and higher lows. You see this low made in October, higher high in December, higher low at the beginning of the year, very briefly another higher high, and then also a higher low. So the signs were there. We felt like it was the right point to make that call to say, that there's been enough volatility that's been removed from, call it the aggregate of the market, that this feels like a spot to get long. And SPY at least has been roughly plus 14% since that point. So just real quick to summarize, and then this will be it. Again, we try not to get in the business of making these flashy calls because I don't know that that's really what we want our process to be. We want it, again, to be more reactive than predictive. But as we look at the signals today, and again, this is why it's important to subscribe, because this could change next week. We could see something different. So, don't hold it consistently through the entire quarter. But we're not just trying to make projections here. We're also trying to rank order them. I think the clearest projection to make is that inflation is returning. And what's the clearest derivative of that is that oil and energy would remain bullish in that environment. Then it starts to get a little harder. Does that necessarily mean that bonds stay bearish? Probably, but not necessarily. So does that continue to be an avoid? It certainly does for now. And then the last two, it starts to get muddier. Does this mean that the dollar continues to go up? I think that's going to depend on the Fed. If they're going to surprise hawkish, and because of the inflation numbers that they're seeing on a lag, if they're going to, whatever that looks like, it doesn't have to mean a pause or a resumption of interest rate hikes. There's different things they could do to sound hawkish. The market may not like that, and equities may go down or up or whatever. The dollar is probably going to go up if they continue to show a hawkish or a constrained monetary policy tilt. And then the last thing here, which I put a question mark because we're the least confident in, is what does that mean for gold? Air quotes, it should mean that gold goes up, but that's the harder one to, I think, predict. So again, we're trying to not just rank order our signals in what we present every day and every week, but also rank order our calls. I think that's important. It's not just to throw calls at the wall and see what sticks, but to say, like, well, where do we have the highest confidence? And right now it's that inflation's in returning. Great call. How do we make money on that? Oil and energy as of now. And then everything else is sort of second fiddle to that. So what we're in the very immediate term, and I'll end here, waiting on are appropriate sizable dips in things like oil and energy to really take those positions up, and the dollar as well. So we're looking at those every day, every week, and just looking for those spots to make intelligent risk reward decisions.
Beautiful, Joe. Beautiful. Hit that pitch into the grandstands. That was very helpful for me. And I play with the Swami data every day. And so I'm sure that anybody who's less familiar, or, this is a lot of great nuggets in there. Let's wrap here. We both got to run, but let me share my screen here and plug a couple things and get us out of here. Actually, maybe I'll tee up a couple questions on the way out. First things first, got to plug our stuff. Follow us on Twitter. We're at Swami Research. And we generally tweet 2, 3, 4 times a week, the latest readings from the machine. And you might be thinking, I want to subscribe to all these sweet quantitative tools that Joe was walking us through. Just click right here, go to www.swamiresearch.com, and there's a download thing that you can put your email in and get the download. And you can get the email sent to your inbox every day for free, or 5 days a week, I should say, from Swami for free, and you'll get our latest readings on over 250 ETFs. So cool, that great stuff there. And really, I mean, here's really what I heard Joe say. I mean, there's a lot, but as a non-propeller head myself, a couple of key points. These are just going to go back through his slides. Well, a couple to clarify. One, check this out. So this is great. This is like, if nothing else. So I mean, here's a couple, like, first and foremost, the Swami score will prevent you from holding bags. It'll prevent you from holding onto a falling knife that's going to cut your hand again and again and again. And here we are ranking Swami scores by decile. And as you can see, the lowest Swami scores have the biggest drawdowns over time. Highest Swami scores have the least drawdowns over time. So buy high Swami scores, or at least avoid low Swami scores, and that's going to help your portfolio and probably your peace of mind significantly. Anything to add there, Joe?
I think it's the important distinction there is, there's two ways to look at back testing. You can look at how, the profitability of something, but also the maximum drawdown, because none of us are robots and we're all prone to making emotional decisions, particularly at the worst possible time to make those decisions. And that's why the drawdown component of whatever strategy you're employing or looking at is arguably the most important, because that's where you're most likely to make a bad decision, is when you're at the low point of a drawdown. And we're trying to avoid bag holding, like Turtle said, in any capacity, because just rather than having to challenge yourself with making the wrong decision at the wrong time, just take that time out of the equation and don't have to make that decision. So that's what we're trying to do, is allow you to unemotionally cut the things that are showing you very clearly and quantitatively that they're not working right now.
Yeah, very well said. And so last slide, and got to show this kind of blocky. I don't know who put this slide together, but let's just look back 1 month on price changes of the S&P sectors, and let's look at our signals, because as Joe said, we rank order the sectors from a month ago, and hey, that in that case it'll work swimmingly, right? So it doesn't always work out this well, but we got your best and worst performing sector just by following the Swami score from a month ago. And here's the last thing, and I'll close on this slide. And I thought that this was good, and give Joe opportunity to say anything else he wants to say. But I learned a lot from this presentation. I thought it was great. And really, what I think is so great about this slide, and Joe, you said it so perfectly, it's that, again, so we're preventing drawdowns, we're avoiding drawdowns, and then we're recycling capital into higher scores. But you don't really want to sell, for example, investment grade bonds and buy energy stocks. I mean, maybe you do, but from a capital recycling standpoint, what we can really help you do, I think, with this tool is what you can do is continue to buy strength in the buckets that you need to be buying. For example, if you're talking about S&P sectors, you can see where you want to be buying right now. If you're talking about market capitalizations of stocks, high short interest, low, you see what I'm saying. Cryptocurrencies, right? You want to be in the strength, and you want to avoid the weakness. And so that's really what I think the score can do. There's a lot of great stuff there, and I want to zoom in, double click or whatever on certain aspects of it, but to time constraints, we're not going to do that today. We will do that again soon. I thought this was great. Joe, do you have any closing comments?
Just one. If you jump back to that prior slide, just to kind of put a bow on
the drawdowns.
With the drawdowns. No, the one you had before with the rank ordering from August 6th. Yeah. Great that we got the top asset right, and that it's up whatever percent it's up in that time. But I think equally importantly, as you look at utilities, the utilities been bottom ranked month, and I just went back and looked since August 6th. Even though there was a fractal reversal signal that day saying, hey, this might be a spot you want to bottom pick, it's down 3.5%, which if it's a big enough chunk of your book is going to really hurt you over time. So it's not just the getting things right. That's great. It's also keeping us out of things that are not so great, even if our heart wants to be in them, like utilities should be working in a constrained, risk-off environment, risk-averse environment like this. It just hasn't been. So that's the other side of that coin, and what we're trying to do as equally as we are trying to get the things right that you should be in.
Thanks very much for your time. Thanks for listening to Swami Research, Real Assets Weekly. And please, in the comments, let us know what else we can clarify for you and how else we can be helpful. Thanks again for your time, Joe, and we'll talk to you guys all soon.
Take care, everybody.